Good morning and welcome. Patriot Radio News Hour. Joe and Jason on this Tuesday, and I hope it finds you well out there. Man, we got a lot of stuff to talk about. We do every day, right? It's always something new. More plans coming out for the new Federal Reserve, possibly a new accord between the Treasury and the Federal Reserve. What does that mean? We got China on a holiday. It is the Chinese New Year. Everything closes down. It's not unexpected. We got a big pullback here. Listen, right now, I'm just going to flat out tell you. You want to buy this week. Probably today. I don't know. Are the bottoms in? I think they are. But we, as an example right now, gold or silver's down $3. Gold's down $100. Run to your phone and get all you can. Take Silver Eagles. I'm going to make them pretty much irresistible here. Rolls of U.S. Silver Eagles are going to be $1,825, and I have the right to raise it or lower it depending on when you call. But if you call this second, that's what they are going to be. $20 gold pieces. Same thing. I have the right to change the price at any moment. But for this second, $49.95. $49.95. Rolls of Silver Eagles, $18.25. For however many seconds this lasts. Listen, I'm going to tell everybody, and I've been trying to tell you. Okay, listen. Run to your phone. Well, maybe you stop listening and run to your phone. I don't know which one I want you to do. I want you to listen, or do I want you to go to your phone? I don't know. Gold is going to be over $6,000 before the end of the year. I you know what? I'll be honest. That's kind of a wussy call. But I'm always a little conservative on price. Silver, $150. Wait a minute. You're saying silver's going to double, more than double from where it is right this second? Yes. This is nothing. I can't say what I want to say, but this is BS. This is just paper market BS, and it's a good time to do it, especially with the Chinese gone for their, I think it's the year of the horse. I think next week we're going to see the resumption of the rally. We may see the resumption of the rally today. I'm not kidding. By the way, silver now $74. Okay, $18.25 is getting ready to go away. U.S. Silver Eagles right now, $18.25, $20 gold pieces, $4,995. Before we get to the break here, just a quick update with Texit. I know some of you, well, probably most of you, probably a little upset, and you know what? You have every right to be. However, I'm a little more optimistic today than I was yesterday. But we have a call. Bobby will be on a call tonight to give everybody an update on what is going on. But there are a lot of things that have happened lately that make me feel this way, including the state of Texas. They've lost a bunch of these cases in the last year or two, and I'm hoping they're going to lose this one as well. Again, because I don't know if it's a security or not. I don't know. I don't think it should be. But there was no fraud, right? The mine was being built, the equipment's being bought. So I have the right to change my mind on that as well. But I wanted to at least give you an update. There will be a call today with Bobby, and he'll be giving you an update. Same thing. I don't know about Iskander. If that's going to be rolling on Friday. Tomorrow we'll spend a lot more time on Texas. How's that? Tomorrow we can spend a lot more time on that and do all of that. Today, want to focus. So we're starting to get a lot more information about what we can expect when Kevin Warsh becomes the new head of the Fed in May. Yesterday, we talked about the raising of what they would consider acceptable inflation up to 3.5%. Today, we'll focus on this talk of a Fed Treasury Accord when we get back. Let's take a quick look. Remember, the markets were closed yesterday for the President's Day holiday. Right now, the Dow is up 80. The S&P's up 5. The Nasdaq's up 3. The 10-year note at 406. Crude oil's down a little bit on maybe some progress with Iran. You know how that goes. Today it's progress. Tomorrow it's not. But right now, gold down $100 here, 49.95. Silver right now is at 73.5. So silver's moving back and forth here, kind of bouncing around. Again, I think this is going to be kind of the last hurrah here on the paper silver price. So we're going to have to, again, keep our fingers crossed here as to what is going to happen with Texacoin. But the Clarity Act, it looks like it's going to pass here, which the head of the SEC just kind of came out and said enforcement on crypto is over. So maybe some blue skies ahead here, but we'll learn more. You know what? I'm getting way too far ahead of myself. We'll learn more tonight, and we'll talk about it tomorrow. But again, silver and gold is on sale right now. $20 gold pieces. I'll be honest. I didn't think we'd see this price again. I didn't. And I don't know how long we'll see the price. Literally in 5 seconds, gold could be back to even. But right now, $4,995 on $20 gold pieces. U.S. Silver Eagles, $18.25 a roll. Think about, what was it, Monday, yesterday, Friday? They were $19.75. So a huge discount right now. If you're looking for something, hey, that's a little still out of my price range. Rounds at $16.70. We are still out. 5-ounce silver bars. Can't get them. Cannot get them. 1 ounce silver bars, $85. I'll put those on sale today. $85 for a 1 ounce silver bar at 800-951-0592. So why is everybody, I don't know if you've been seeing everybody is jumping up their price. UBS today, gold's going to be $6,200 by June. By June. Why? Why are they making these comments? HSBC. Hey, gold and silver is our safe haven. That doesn't mean they're not going to be volatile. Everybody just relax. Prices are going to skyrocket. Why would they be making comments like this? And the answer is very simple. Word is starting to come out about how much change is going to be coming to the central bank and the Treasury due to the avalanche of debt. So number one, hey, they'll cut rates all the way up to at least 3.5% inflation. Forget about 2%. That's dead. 2% over. Now they're going to use a range, which is kind of a joke, right? Oh, well, 2.5 to 3.5. What does that mean? I mean, it's pretty simple. Okay, so 3.5. Then word about this accord. People don't know that the Treasury and the Federal Reserve have done this before. What does it mean? What are they working on? Simply put, they want to try to control the interest rate. Because obviously what has been happening today, the Fed cuts rates, the low end of the yield curve falls, but the high end doesn't. Right? Think about when the Fed made the first cut. Remember, was it the end of 2004? They cut 50 basis points. The 10-year note was at 3.8%. Now, today it's like 406, right? But it's pretty much been 420, 430, right? Let's just say between 4 and 4.4. And yet the Fed has been cutting. And the long-term yields are rising. The short-term yields are falling. And it's showing you how little impact the Fed really has with interest rates. So they're coming up with an accord. The last time they did an accord was after World War II. And what does this accord mean? Simply, they're going to set up an interest rate. And let's just, for argument's sake, let's just say it's 4%. Okay, and I have no idea what they're going to say. Okay, and this is for longer-term debt. All the debt that trades over 4%, right? 5-year, 7-year, 10-year, 20-year, 30-year. At that point, the Federal Reserve will buy all the debt that isn't bid below whatever they set the rate at. Now, there's two ways to do this. One is just what I said. Okay, it's a 10-year auction. We're auctioning off $50 billion of 10-year notes today, and we won't take a bid higher than 4%. Now, they may sell some of it, none of it, right? Like today, they would probably sell none of it, right? 10-year notes 406, and I don't know they'd get any bids. But again, let's just say they sell 40 billion of the 50 billion. Then they got no other bids above that 4%. The Fed would just buy all of it. And they would do that auction after auction after auction, right? Quantitative easing, but on a massive scale, right? Now, that would be kind of, let's just say that would really, really blow up the Fed's balance sheet. Like, forget about $10 trillion, right? We're talking about $20, $30 trillion. My guess is they are going to do an accord. And they're going to set a rate, whatever that number is. At the same time, I think they'll change the rules and allow for banks to essentially do nothing other than buy treasuries. In other words, hey, banks, you don't have to buy mortgages anymore. You don't have to buy this debt anymore. You can just put your whole balance sheet into U.S. treasuries.
And they won't have to go to the Fed to get it. They'll relax the regulations. They'll let them borrow. So let's just say Palantir wants a big, huge amount of money, and the bank that they go to doesn't have the funds ready. The bank can just give it to Palantir. Now there's less treasuries that need to be bought on the backside because the bank just bought some on the front side to ease the Fed's buying of whatever doesn't sell at the auction. This is where these regulations go away. And I find it interesting because what the attempt to do here is to burn off the inflation over time by doing this. And in the 1950s, when they did this accord in 1951, there was inflation. It was pretty bad, actually. And I've been rewatching episodes of Leave It to Beaver, which started in 1957, just a few years after this was put into place. And the funny thing about that show is they were always talking about the cost of things. Wally needed $5 for this, or Beaver needed a quarter for that. They were talking about the prices and how the prices had gone up. And Ward would say, "Well, when during World War II, this is the price of this stuff." So the inflation comes behind this thing, and it can be pretty dramatic, especially where we're sitting today. They're going to try to burn it off, though. They're trying to make the debt to GDP right. And during Leave It to Beaver's times, they were able to raise the rates that they were paying employees. So yeah, everything cost more, but everybody had a higher paying job. That's going to be the trick here, huh, Joe? We're going to have stagflation. I don't see that. I don't see how they're going to pull that trick off.
It is, and Jason and I have been talking about this, for years now, that there was no good option. They went with, they had to pick something, and they picked inflation. That's just what they picked.
And it's best, and it's the best for their rich buddies. Let's just face it. Out of the two options,
and
rich guys with assets,
you could argue like it's the least painful way, right? We just don't want the pain. Let's just keep kicking the can. I know that, you know what, at the end of this, the can's probably going to go over the cliff, but hell with it, kick it anyway, right? And at least it'll be, okay until it goes over the cliff. This is a way, and Jason really put it very well, to try to hide the effects of inflation, right? And trying to mask it by not allowing for true price discovery in the debt market. That's what this is about. We can't afford to pay the true cost of the debt, the true cost of the inflation. And the problem is, like Jason said, well, gosh, they just paid everyone more money. We've already done that. That already happened. And now we're sitting here probably staring down the barrel of stagflation. And just think about how terrible a U.S. Treasury note will be if inflation runs at, say, 4%. But by the way, to get 4%, you've got to borrow from the government for 10, 20, or 30 years. That's a terrible return.
Sir, yes,
800-951-0592, Patriot Radio News Hour, Joe and Jason. On this Tuesday, it is the Chinese New Year. The markets are closed in China, so they're squeezing the last drops out of it before everyone turns around and goes the other way. Right now, silver $73.55. So we got some great items here, right? $20 or rolls of U.S. Silver Eagles, 18 and a quarter, $1,825. Silver rounds all the way down to $1,670. Silver rounds are over $2,000. Listen, $100 silver rounds are going to be way over $2,000. 1 ounce silver bars, $85. So I got something for any of you and all of you in the silver market. Then the gold market, I thought this price was dead. And it will be. Maybe as early as the next hour. But $20 gold pieces for this second, $49.95 on a $20 gold piece. If you guys want to trade some silver for gold today, listen, I'll get you a really good price on your silver, better than what anybody else out there pays. And we'll get you into these $20 gold pieces if you want to just lighten your load here. But below $5,000 at the same day. Like, I'm not kidding. Like 6 banks today raised what their gold price forecast is going to be. Goldman Sachs, our $5,400 price target, all the risk to that target are to the upside. So in other words, Goldman said, yeah, we know we're way below where it's going to be, but right now we're just going to tell you all the danger is to the upside. And of course, the news coming out of the Treasury. This is a multifaceted attack. The Trump administration, love them or hate them. And right now, I think that's pretty much all you have, right? You either love them or you hate them. They have said from day one, we are going to try to print and grow our way out of the problem. Well, what's the problem? Debt to GDP. Debt to GDP is the problem. Right? If you have a $30 trillion GDP and $40 trillion worth of debt, that's a problem. What's the plan? We're going to try to grow faster than the increase in the debt. That's the plan. That plan literally has never worked. But like I said, there was only 2 choices. One, stop spending. Right? And again, yesterday, remember, we went over this yesterday. Fire everybody. And when I mean everybody. You pay the military, you pay nobody else. You don't pay the people, the senators, the House of Representatives. You don't pay the judges. You don't pay for people to working in food stamps. You don't pay the IRS. You don't pay anybody. You know what that saves? Ready? Grand total, $300 billion. That's it. That's all that was worth. Obviously, they're not doing that. Well, then how else can they save? Well, they can cut military spending, right? We know the answer to that. I'm not even going to start there, right? That's all they do is spend more, right? War drums beating, war drums beating, war drums beating. I just saw, oh my gosh, we got to restock the 30,000-pound Buster bombs. Yeah, I don't even want to know what one of those cost. Don't want to know. I wonder how much silver's in one of those. But anyway, not going to do that. Okay. Well, what else can we? We could cut Social Security. Anyone see a snowball's chance in HE double hockey sticks of that happening? Nope. We can cut Medicare and Medicaid. By the way, that's coming anyway. Got bad news for you. That runs out of money before Social Security. So just telling you that. That's not going to happen. Look at what happened when they tried to do it. They were just going to cut just a sliver of it. Remember, government shutdown. Oh, my gosh. And then what happened? Obamacare premiums through the roof, right? Blah, 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 and all that stuff. The only thing that they can think of, well, maybe we can save a little bit of money on the interest by coming up with this quote-unquote accord, which is nothing more than interest rate control. What happened when that accord ended? Oh, that's right. The inflation of the 70s roared. What else happened? See, here's what else happened. Up until the last, say, 15 years, the largest amount of gold was bought by central banks around the world. See, before this accord, do you know the United States had still almost had in 1951 almost 20,000 metric tons of gold.
Yeah.
By the time they shut the gold window in 1971, they said that they had 8,000 metric tons. So why is everyone raising their gold and silver forecast? Because they're like, oh, crap. You guys are going to... Now, listen, here's the funny part. They did this accord, and the debt wasn't even $400 billion.
Yeah. This whole policy is a disaster, Joe. On the other side, I can explain it. You cannot do what you did back in the 1950s. That's what they're going to try. But I can explain exactly why it's not going to work. Because the world is a different place than it was in the 1950s, Joe.
Run to your phone and get your gold and silver. 800-951-0592. We'll be right back after the break. 800-951-0592. Patriot Radio News Hour on this Tuesday. Take advantage of the Chinese New Year. This is just my opinion. I think my opinion's worth something. I've been doing this for a very, very long time. This is nothing more than taking advantage of getting out of some short positions. Get the market down as low as it can go. Close out your short positions before the Chinese get back to work next week. And get ready for the policies of the new central bank. And Jason, before the break, you were explaining, listen, this is not going to work like it did back then. Think about this, not even $400 billion in debt. Now we're going to talk about $40 trillion in debt. But lay it out for everybody.
Well, and the debt is the whole part of the issue is the debt to GDP, which is similar to World War II. World War II, we had a industrial we had a wartime industrial economy. We were building at a massive rate to win the war. When the war was over, we were able to continue that. Why? Why did that continue for almost 2 decades? Because we rebuilt Japan, we rebuilt Germany, and we rebuilt most of Europe. And so as we were letting this inflation rage, we were able to, grow our way out of it. That's where all of this comes from. But we don't have a tremendous world-smashing war that destroyed whole cities. We don't have any racing industry in this country to sort of build our way out. So we're going to have stagflation. And it's going to be really bad. It's going to almost feel like hyperinflative stagflation because as they put this into place and the debt just gets bigger and bigger and bigger as they try to stay on top of all of this spending that they're doing, it's just not going to keep up. It's going to Here's the thing, America, at least we're slightly insulated from this. Down the pipe from the dollars is who's going to really have a lower standard of living. I was just watching a video of a guy. He was taking videos in Hamburg, Germany. Considered at this point in history, okay, this is Germany, right? I watched the video. This guy, you're walking around Hamburg, and the guy gets chased by people. If you walk into the wrong area of town, you get chased and possibly attacked if you're not welcome there. And the laws say that if you defend yourself, attack back, you get arrested. That's lower standard of living. Germany does not have the standard of living that we have. Even though Europe's considered a higher standard of living, this is grinding to a halt. There is no jobs to go rebuild Japan. There's no job. We're trying to build an AI technological system. That's not building roads. I mean,
that's actually going to be less jobs, right?
Yeah, and look, all that rebuilding didn't sop up enough inflation because what do we have? You had Eisenhower in 1956. He did the interstate building project. He's like, where are we going to put these workers? We're running out of Japan to build. By 1956, we were still building Germany. Germany was even worse than Japan, but we were running out of. And the Japanese were hard workers. Like, no, you guys can leave. We want these jobs, and we'll finish rebuilding this. Just give us the money and the building materials. And so, what do we do? Well, we could use an international or a national highway system, like the one we blew up in Germany during the war. Let's build one of those. Right? They took on a bunch of the German policies to build the economy and try to get us out of the GDP problem. It worked. They were able to burn it off. Joe, I don't see any case how we're going to burn off this inflation. How is it actually going to happen? Joe talked about how this 1951 accord slowly but surely brought us to the 1970s inflation. Well, that was a 20-year time frame. What do we got on this one? 5 years if we're lucky? I don't think so. We're going to see the inflation start right away, and it's going to get worse like the 70s, and it's not going to be. It's going to be the 2030s where this thing is going to be roaring. So yeah, there's going to be a big emergency, Joe. I don't know how bad it's going to be. The only way they can cover this one up is something bad's going to happen.
Yeah, and it's where does all the money come from to do all of this? They're going to print it. They're going to print it. This will weaken the strength of our banks. At the same time, it will make buying dollars, the dollar as the reserve currency of the world, will be further in jeopardy. And you end up doing what Japan does. I mean, this is how Japan started doing all this
right.
stuff. We're gonna control the interest rate, right? And how is Japan able to run a deficit of 200% of GDP? Well, they don't pay any interest.
And the way they got out of this mess is Nixon. Not only did he shut the gold window, but he was also the first president to get into China. And he sent all the labor there. He's like, well, let's just turn it into a world system and let's get it all. We got cheap labor there. Well, I don't even know if anybody in the world has cheap enough labor for what we got going on. You can't go to Africa with this. Africa's labor is too expensive versus Chinese labor back in the 70s.
Yeah,
there's no way to do it.
That trick's been played, right? I mean, that's when you go back to free trade, right? Free trade was really about, well, gosh, America's too expensive. How can we send it somewhere else? And, of course, remember, I've been telling you, the deal was, we'll give you all this stuff. You keep buying the debt. Now no one wants to buy the debt anymore.
Right.
Can you blame them? $800-951-0592. I am putting an all-out buy alert for today. Well, the Chinese are celebrating what is going to be, I guess, the new American weak dollar policy that I think, well, Jason's talked about this a lot. Listen, we're going to lose. What happens in all of this? We lose the majority of the middle class. That's what happens. Yeah. We'll have 10% of the middle class become rich. We'll have 10% of the middle class, maybe 20% of the middle class stay there.
I don't even know about that.
Yeah, and then the rest of it, 70, 80%, go into poverty. Don't let that be you. If you put your gold and your silver away, it will not be you. It is absolutely on sale here. What is the paper markets doing? Taking advantage. This has probably been, listen, they're so far ahead of us. This was probably the plan when they crashed it back, a few weeks ago. Hey, we're going to go all the way to the Chinese New Year. Wherever it is at the Chinese New Year, let's get it as low as we can, get out of these shorts, and get ready for the other way. And at the same time now, we're starting to get a much clearer picture of why Kevin Warsh was the selection. Some of you, if you were a news junkie like me, people, oh my gosh, Kevin Warsh, he's kind of a hawkish guy. Yeah, well, I guess we can end that debate completely. Not only are they going to raise the inflation target, and obviously because of the accord, man, that makes a lot of sense, right? Very smart. Let's raise that at the same time. Let's create this new accord so we can try to control the long end of the yield curve so we don't have to, at least for a little while, pay for all of the damage that we're going to cause by the amount of debt that we are going to create. This is an avalanche of debt. This is, forget it. I mean, I knew it was going to be a lot. I did. I'm thinking, okay, we'll probably start running $3 trillion deficits. Jason, I think we're going to run 4. I mean, this is asinine. This can work for a very short period of time, but that's it.
Yeah. Well, and I think that's what it's meant to be is a short-term solution, and then when things go bad, that's when you have to change the narrative, and it's always the change in the narrative that gets people to accept the lower standard. This is going to create lower standard, and right about the time people feel the pain, they give them something to be afraid of. Fear overcomes the pain, right? Well, I don't want to feel more pain. I guess at least I just have a bad situation. At least I didn't die in the fake bombing incident, right, Joe? That's that's what they do every time.
You laugh. You don't laugh. That's about right. 800-951-0592.